Hello and welcome to the Penobscot Financial Advisors quarterly investment update for Q4 of 2020. Today is November 2nd, and we'll be guiding you through a little update for you today. My name is Sam Chaplin. I'm the Associate Portfolio Manager. I'm joined by our co-founder and Chief Investment Officer and many other things, James Bradley.
Hi, everybody.
Hey, Jim. How are you?
Great. How are you doing, Sam?
Doing good, thanks. So try to keep it fairly short for you today, but we will post a slide deck for you online for anybody who wants to dig in deeper. On the agenda, we're going to take a quick look at economic review. We're going to look at how that's impacted markets and then some of the themes we're looking at going forward. So with no further ado, I'll hop right into it. Our first slide here is a slide of US GDP percent change from preceding quarter. Biggest thing you'll notice here, the giant moves in the last couple of quarters. So Q1 was kind of the beginning of coronavirus when the lockdowns initiated, and we were down about 5% there. And then Q2, we were down a record 31.4%. And then numbers just out for Q3 up about 33%. So nice looking rebound. Unfortunately, I wish I could say if you're down 30% and up 30% again, then you're back where you started. But
math doesn't work that way, does it?
You wish it did sometimes. But this next slide will give you a little gauge on where this recession stands relative to some of the ones that have happened in the past. And here we're looking at what GDP was the past 12 months compared to the 12 months before that. And by that measure, we're down about 10%. For the preceding 12 months. In this chart here, you're looking at length of the recession on the vertical axis and years on the horizontal axis. So we're down here in bottom right-hand corner, about 10.1% down. That is, at the moment, the third largest drop in GDP back to 1910. However, the shortest at the moment. This is kind of a man-made recession, and we kind of force it upon ourselves, which kind of changes from more like systematic recessions, like the financial crisis, for example, that took a lot longer to dig out of. So be looking at these numbers going forward, hoping for another quick rebound in the fourth quarter. But some of those easy rebounds have already been had, and it's going to be a little more of a struggle from here on out to get back above where we were.
We may go the rest of our lives without seeing such a big recession and without seeing such a short recession, hopefully. So, right, jumping in on, what that has ended up looking like from an employment standpoint, because that's really been the biggest impact. And you can see that, going into the pandemic, we were kind of level at, a few million continuing jobless claims and just kind of going straight across for quite some time. And then the huge bump up that we saw back in April and May. Since then, the good news is it's coming down, and the bad news is it's coming down a lot more gradually, obviously, than it went up. It's going to take a good bit longer to replace these jobs and to get everybody back to work than it took for them to lose their jobs. So at this point, we've recovered about 47% of the jobs that we've lost, and we're fully expecting that number to continue to improve, but again, not as quickly as we saw it crack. When we're looking at what's actually open, where jobs potentially are coming back, but also where the economy is recovering, it's kind of interesting to look at the fact that people are buying houses, they're mortgaging houses, they're refinancing houses. So mortgage applications are at a level well above where they were a year ago. Another thing that's come back a little bit more is overall consumer spending. People are buying stuff. They're not necessarily buying services, but they're buying, objects. And that's come back pretty well as well. And that kind of bodes well for the upcoming holiday season. When you think about it, when people buy holiday gifts, they tend to give things rather than services. It's the service sector that really hasn't come back all that significantly. So people aren't traveling. They're not going out to dinner quite as much. And that shows up in hotels and TSA traffic and that type of thing. So obviously those things are the places where the economy has yet to fully recover. And that could be bad news or good news, because the good news is that's a big part of the economy that could recover once we do have the ability to, through therapeutics or vaccines or what have you, start to get things back to normal. Looking at interest rates, that's another, outflow from what we saw there in the economy. We saw the Fed really step in and try to prop things up by making money more accessible. This chart looks a little bit different than sometimes it does in one way. What's not different is the long run projection for the Federal Open Market Committee. You can see it sitting there as a purple dot right at 2.5% as a long run projection. But gosh, that's become a really long run projection, because you can see that the actual estimates from the Fed standpoint and from the market standpoint are pretty much at zero for at least the next couple of years. And this is one of those rare situations that we see where there's really no difference between what the Fed is projecting and what the market has kind of baked in here. Money's going to be cheap and easy for the next couple of years at least. And again, that's got some downsides to it, because we don't have the ability to make money in things like fixed income markets, but it also becomes a very accommodative environment for the economy to come back when we do, again, hopefully get back to somewhere near normal.
Yeah, definitely a double-edged sword there. Borrowing will be nice and cheap, and that's good for growing your company. On the lending side, though, it's not going to do well for your savings accounts or investing in fixed income products. So
Right.
good with the bad. All right, that wraps up the economic review. We're going to move into the market review here. So this is a chart you might be familiar with because we bring it up fairly often. This is a price to earnings ratio chart going back through the 90s. Quick crash course on the price to earnings ratio is that it's really a measure of how expensive stocks are. How much in price are you paying for a dollar of earnings is the way to look at it. One thing you'll notice here, though, in the dark gray shades, we have U.S. recessions, and the price earnings multiple tends to really pop at those times because price is a forward-looking metric. You're looking at what you think the company is going to use, make in the future versus earnings, which is looking at the last 12 months. So it's a good thing if the price is going up, expecting that earnings are going to go up right now and be higher than they were over the last 12 months. But you can see coming into this recession that we were at pretty average levels that actually bounced right off the long run average there of around $19 in price for dollar in earnings. And that really has skyrocketed up. But that's kind of to be expected, and we should see earnings go up over the next 12 months and really pull those back towards the average if all goes well. And then to kind of pop under the hood a little bit further and look at these style maps. So a style map, you can see on the vertical side there, you'll have small, mid, and large, and that's what you would think it is in market capitalization: small companies, mid-sized companies, and large companies. And then across the top, you have value, blend, and growth. Value being more companies that you think are not priced as high as they should be right now. Maybe they're undervalued. And on the growth side, you're thinking that they're going to grow faster than the economy as a whole. Big dispersion here in returns, as you can see year to date. On the growth side, some pretty nice numbers in returns. We're on value side, quite the opposite. And that's just kind of a function of how consumer behavior has changed and business has changed during the coronavirus. I think a good example is maybe if you were buying your products from Rite Aid and Walgreens in the past, that would be a value company that you're buying from, but now you're probably going online and buying those from Amazon. Or same idea with the Apples and the Microsofts of the world, who are not as sensitive to coronavirus, that are on that growth side, that have ended up doing pretty well from the stay-at-home changes and trends. And then over on the right side here, you're going to be looking at the price to earnings ratio as it stands now versus the 20-year average. So you could say if it's above the 20-year average, it could be overvalued. If it's below the 20-year average, it could be undervalued. You're going to see a lot of over 100% here. And that's much of a function of what we looked at the last slide, which is earnings haven't really caught up with the prices yet, and we hope they will. But also as a function of how the returns look in the left-hand graph there, you'd see that the growth side is now looking more overvalued than the value side is. So that's something we're going to be watching going forward. And again, you would see some of those nice stay-at-home stocks on the right side, where you'd see more of airlines, energy, financial services on the left side, things that have really struggled to bounce back and could be good value opportunities at this moment.
Right. We really don't want to get distracted by shiny objects in this kind of an environment, do we? These things do have a tendency to kind of revert to the mean over time, and obviously large cap growth has been the place to be, gosh, and growth in general. But how much longer will that be the case, especially as things get back to normal, is really what we're looking at.
Indeed.
Well, I get to, this is another thing that we talked about last quarter, but the trend has persisted in what we were just talking about. This is large companies, mega cap companies outperforming, and that's what seems to be driving the S&P 500 higher, when in fact the average company in the S&P 500 index through at least the end of the third quarter is performing lower over the course of the year. Because of the fact that the S&P 500 is a market cap weighted index, the larger companies in it do have a bigger impact on performance. And so this is just another way of looking at the fact that that is really the story when we see, stories about the S&P 500 actually being up on the year, and people looking at their stock portfolio and thinking, gosh, I've got stocks, but most of them are down. Well, that actually works out. Most companies in the U.S. economy right now, their stock performance has been negative over the year. It's just been those few companies that have been holding it up. Important again, though, not to get too distracted again by shiny objects, because if you look at how large companies have performed recently, it certainly has been remarkable. But to what extent can they maintain that kind of outperformance over a long-term period of time? And if we go back way back to like 1970, which we see on this chart here, in fact, over the longer term, the equal weight S&P 500, the average company has performed better than the more heavy weighted toward large company S&P 500 index. And that's largely due to the fact that over the longer term, the bigger companies kind of end up getting a little bit kind of throttled on where how much further they can grow. And the smaller part of the index is the thing that tends to lead in growth over the long term. Not all the time, and certainly not over the past, number of years, but we need to pay attention to longer term trends there as well.
Absolutely. And I know everybody's seen the Facebooks and the FANG stocks flying high, and you can kind of see this interesting pattern right here of where there's a bit of a cyclical rotation out, as they call it, where the first reopening was happening, everybody got real optimistic, and you see those equal weighted stocks really start to catch up with the larger stocks. And going forward, we'll be watching for that. People selling their Google shares and buying some airline shares, that type of thing. So that's something to watch out for.
I guess one other thing we might want to talk about as well is when we're looking at how we select investments, certainly into our portfolios, criteria that aren't necessarily directly financially related also weigh in importantly. And for us, and pretty much across the industry right now, criteria based upon environment, social issues, and governance, or ESG, are things that we do look closely at. And when thinking about those things in the past, there's been kind of a misconception that, well, we're doing that just to be socially responsible with the investments that we're in. We certainly do want to be, but at the end of the day, it's becoming more and more obvious as time goes by that those types of factors are going to play a role in how the portfolio performs. Companies that are better stewards of their environment, of their communities, of the way that they govern themselves, also tends to do better over time. And that shows in this picture of this graph that goes back about 12 years, and a steady overperformance of companies that are leaders in those important areas over the performance of companies that aren't. So we'll continue to look heavily at those factors as we invest, both with a sense of trying to make sure that we're investing in things that do make our country, our planet, a better place to be, but also in a way that makes sure that we're extracting as much value as we can for the investors that are putting their trust in us.
Absolutely. You know, I'm a big proponent of ESG. You hear it go by different names: stakeholder capitalism, conscious capitalism. The idea that you're really going out and voting with your dollar and the things you invest in, and that the things you invest in should hopefully make the world a better place, and at very least not make it a worse one. So I think that's a trend that's really been taking hold. It's kind of a newer idea that's kind of waiting to be proven, and I think this recent downturn was a kind of a proving point for them. Where the ESG companies have maintained, you know, more loyalty from their customers than companies that haven't been so well to their stakeholders.
No doubt.
On the next slide here, we're going to zoom out. We've been talking a lot about domestic equities, but looking at the global side. So here we got in the teal color, we got US equities. In the blue, we have developed world equities, so international, but not including the US or emerging markets. And then that light gray line is the emerging markets performance year to date. So recently, for a better part of a decade now, the US stocks have been outperforming pretty large, but that's also mean they're trading in higher valuations than a lot of their international counterparts. And this chart kind of goes to show the diversification benefits, especially in the most recent downturn over the last couple of weeks. Something like emerging markets, which might be a riskier asset class, but it is less correlated with the US markets, has held up pretty well, while the domestic equities have been selling off, particularly from those technology stocks we were talking about. So kind of goes to show the diversification benefits here of holding international stocks, both in the developed and emerging worlds. China, in particularly, has been charging ahead through coronavirus, so that's probably a big factor in the emerging markets performance there. But not just for diversification purposes, but when you look at the valuations and return projections going forward, it does look like there's a good opportunity for international markets to outperform over the coming years. This is some data we get from Vanguard, but I've seen the same, same projections pretty much from Goldman and all kinds of investment companies out there, where they're calling for outperformance in the global equities. You can see down bottom here at 7.4 to 9.4% versus 3.9 to 5.9 on the domestic side, with barely any more risk in the second column there. And likewise, when we're looking at value and growth, they're looking for outperformance on value versus growth, which has historically been the case coming out of recessions, is that value tends to overperform. And then the large caps, again, over the last cycle have been outperforming pretty large, but calling for the small caps to kind of outperform this cycle. I think this is a 10-year average return looking forward, and kind of, as Jim was saying, looking for things to revert to the mean. If something can't outperform, forever without eventually getting knocked back down.
It hasn't been a bad way of going about it, has it been historically, to look back 10 years and see what's done really well and invest in other things for the next 10 years.
Yep, absolutely. But there's also additional benefits, as we talked about. Those lower correlations on the international markets versus the domestic means that you reduce your overall volatility in the portfolio too. Maybe even if they haven't performed as well, at least they're not all moving in the same direction at the same time, which kind of allows you to ride a little bit of a smoother line and gets that overall volatility down. As you can see here, this is another Vanguard chart showing 20 to 50% is the maximum volatility reduction range. So something that we always like to have in our portfolios to improve diversification.
Yep, anytime you can kind of smooth out those downsides, you're doing yourself a bit of a favor. Looking over to the bond markets, the fixed income side of the world, there's a challenge there, just like what we talked about before. I mean, with the 10-year Treasury yielding, well below 1% right now, and probably going to not really be recovering significantly from that for the foreseeable future. Where do you actually get some return if you're trying to diversify your portfolio into bonds? And one place that we would tend to look at would be high yield. Another place that we would tend to look at would be emerging markets. And these are both places, on the fixed income side of the world that tends to both give you a little bit of a boost in returns over time, but also increase the volatility risk that you have there. So, you know, with the significant lockdowns that we saw back in the spring, these are certainly areas that definitely took it on the chin when it comes to their valuations. And now what we look at is what we call spreads, and where there's spreads, there's opportunity. And when the spreads are relatively high, that's more opportunity than we would, you know, necessarily have in a normal market. And what we can see here is that those spreads for those things like emerging markets debt and like high yield debt have stayed relatively elevated, even though the Fed has come in to kind of remove some of the risk in those areas. So not as nearly as high spreads as what we saw in the worst of the downturn, but much higher than we had going into them. So there's still some opportunity there. It is important when we look at correlations with other asset classes like stocks, though, that we consider the fact that the more return that we add as far as potential from the fixed income standpoint, the more correlation that we're going to see with the stock market. And looking at this next slide here, what we're hoping to find is places up in the upper left-hand side where we get much better yields with low correlation. The reality is, though, unfortunately, that doesn't exist. So we still have to be cautious when adding risk to a fixed income portfolio, because whenever we do it, we are adding some degree of correlation to stocks.
Yeah, it is such a trade-off. On the lower left-hand side, you got low correlations, which provide a nice cushion in your portfolio, but you're not going to get much return generation out of them. Where up towards the right, you could potentially have a high amount of return, but it's also going to move in the same direction as the market, so not going to protect your downside. So having a mix of those assets is always important. Here on the return projection side, this is on the fixed income side from the same Vanguard source. Here we're looking at U.S. to outperform international, largely as a function of the fact that U.S. has positive interest rates, where a lot of the international world does not, but just very low returns overall. And that's a function of the Fed interest rate being near that zero lower bound, which means U.S. Treasuries, for example, you're going to look at 0.3% to 1.3% over the next 10 years. So not a lot of yield to be found out there. You can get a little bit of extra by going into high yield, as Jim mentioned, or emerging market bonds.
Certainly, again, one more example of it's been the investment grade stuff and the domestic stuff that's certainly helped us out over the recent months, going back and on the issue of what's got the potential to move next. It is looking like it's more of the more credit sensitive stuff that we'd see in U.S. high yield and emerging markets. So it gives us some comfort in knowing that, despite the fact that, again, they carry more risk and they carry more correlation with the rest of the portfolio, that they're potentially going to reward us, hopefully, all other things equal, if we stick with it.
All right, looks like that wraps up our market review. Talk a little about a few things we'll be watching going forward. No surprises here to anybody, I'm sure. Looking at coronavirus, the election, and fiscal policy, but maybe not in the context you might think. So I will let Jim kick off here, talking a little bit about the coronavirus outlook.
So not to be a bummer or rain on anybody's parade, but obviously there has been a significant increase in cases, as we've seen in the U.S. Fortunately, on the right-hand side, we haven't necessarily seen quite the increase in fatalities to go along with that increase in cases. So there's some hope to be had there. When you think about our ability to actually treat the disease, but certainly that fall surge that we've all been warned about, it's certainly here, and it's something that could weigh a little bit on the recovery and maybe interrupt it even for a period of time. So added volatility in the markets should really be something that we expect during this kind of a period in the pandemic, where we're not yet to a vaccine, hopefully getting closer to it, but still in the middle of a pretty big surge. And the next slide that we see here is, just kind of reinstates that growth in per day cases, but also goes to the unfortunate fact that, in the U.S. we've got, a relatively small percentage of the global population, but certainly have more than our fair share of COVID deaths. There's a lot of freedoms that you have in this country that are maybe a little bit beyond what you'd see in other countries that control the movement of their citizenry and that type of thing. And that's kind of a double-edged sword in situations like this, because we've not been able to do nearly as good a job at controlling things here as they have in some other countries.
And moving on to some of the election updates, standing here on November 2nd. So one day out from the big day, and who knows how long from finding out who's going to be president. But some reassuring numbers here, to be honest, is that a lot of people might think that, market's going to crash depending on what side of the fence you're on if your opponent gets elected or whatnot. But some of the long-term data here, and going back through 1860, shows that based on who is president, has very little to no statistical difference in what the returns of the market are going to be. It's kind of something that's drummed up by the parties and by the opponents, saying that only they can create the market booms and whatnot. But seeing 8.4% of annual compound return for Democratic president, and at 8.2% on the Republican side. So very little difference there. And then when you look at election years versus non-election years on the right, you might think quite the opposite. However, election years tend to have a higher return than non-election years do. Almost 9% for election year returns and 8% for non-election year returns.
Sam, I'm going to go out on a limb. It's November 2nd that we're recording this, and so the election obviously hasn't happened, but I've got a prediction on who's going to win.
Oh, yeah?
Yes.
Bold move.
An elderly white man is going to win the election.
Yep. No surprise there. So, to spin off this, a lot of people will say, oh, maybe it doesn't matter which party wins the presidency, but depending on who wins the presidency means this basket of stocks is going to do better, or these sectors are going to do better, or whatnot. I've been a victim of that thinking myself, but when you look into it, you'll see that investors are not as good as predicting what sectors of the economy are going to benefit from a new president. This is looking back to the 2016 election. In the blue, you're going to see the performance right after the election versus the later performance. So, for example, when Donald Trump got elected, people really piled into finance and energy stocks, thinking that those are going to be big winners under his presidency. However, when you look at the returns after the 2016 election, dead wrong. Like, couldn't be more wrong. So, a lot of people saying right now, buy those if Trump gets elected, buy clean energy if Biden gets elected, whatnot. Easy things to say, but not necessarily going to show you the return that you think it might.
I'm sure sometimes these things probably do work out, but don't put all your eggs into that basket, certainly.
For sure. And I'm sure a lot of these things run up prior to the election, and then you see the sell-off just after it happens. So, moral of the story is that maybe the president doesn't have as much control over the stock market as you think they might do, or as they think they might do.
That's a good possibility. Speaking of presidential elections, this is another prediction I'm going to make right here. I think that the new president, whether it's the current occupant or a new occupant, will be looking very hard at getting some fiscal stimulus through. We've gone through 3 rounds, but I think a 4th round is going to come along. Looking at where we are relative to other developed countries, we're kind of in the middle. We haven't issued more fiscal stimulus than a number of countries, and what is interesting looking at this graph that we've got here is that our fiscal stimulus as a country has much more significantly been weighted towards spending and revenue measures rather than loans, equity, and guarantees, whereas a country like Italy has actually spent less but made more capital available through those types of things. Wouldn't be surprising to me to see in round 4, regardless of who puts it together, a bit more of that purple as part of it, or another kind of extension of payroll protection and that type of thing that we did see as made available. Certainly, we'll also see some more of that gray, though, in the form of actual infrastructure spending and that type of thing. And I think that everybody can rest assured that that's not only very likely to happen, but also has frankly been already priced a bit into the market. So any more than is expected might be an upside, but there's also the risk that less fiscal stimulus comes through the legislative process, and that could also weigh on markets as we go into the new year.
Yeah, absolutely. It's been interesting to see that on the monetary side in the U.S., the Fed has pulled out every tool out of their toolbox they have, and even invented some that they didn't have before. Right. And they've been begging for more support on the fiscal side. It's kind of amazing it hasn't gotten done to date. We'll see what happens with the election. I think we'll get a deal either way. It's just the size of it that'll differ. And as you said, a lot of that's already priced into the market. And looking at this, we haven't spent nearly as much of our GDP as a lot of other countries have. So you can look at that as a downside, or you could say maybe we have more dry powder ready to go if a second wave does come about.
I'm an optimist. I'll go with the second wave. That's
right.
The second definition.
Yeah, it's best that we end on a happy note.
Speaking of happy note, why don't we do this again next quarter, Sam?
Yeah, sounds good. Thanks for joining us, everybody. We'll post these slides up on all social media and on our website. Check out our new podcast, Financial Discretion Advised, and we'll talk to you next quarter.
Talk to you next quarter. Happy New Year, everybody.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.